Hey everyone, welcome back to Corporate Decoder, the place where we decode the wild world of corporate filings. And let me tell you, this report is a doozy. It is like a treasure map, but instead of gold, we're looking for cash and trouble. So buckle up folks, because today we are diving deep into Millrose Properties Inc.'s filings, and there is a lot here to unpack. We'll be looking at their financials, their strategies, their risks, and essentially what this whole exchange offer means for everyone involved. Before we jump in, if you appreciate getting straight insights from these dense documents, make sure you are subscribed and ring that notification bell. We also have a fantastic corporate finance community on Discord, linked in the description below, where we break down these filings further. Alright, let's get straight to it. Millrose Properties Inc., a company that spun off from Lena Corporation, is offering to exchange shares of Millrose Class A common stock for shares of Lena Class A common stock. Think of it as trading your Lena shares for Millrose shares, but with a little sweetener on top to make it interesting. Lena is putting up a massive chunk of their Millrose shares, around 33 million shares to be exact. This whole dance is set to wrap up by the 7th of November 2025 unless they decide to extend it. The big question for stockholders is, why would they do this? Lena wants to get rid of its remaining stake in Millrose, and they think this exchange offer is a good way to do it. It allows you to get shares in Millrose directly, which is now a separate, publicly traded company. Now here is where it gets juicy. They are offering shares of Millrose at a discount. For every $100 worth of Lena stock you tender, you'll get about $106 worth of Millrose stock. That sounds like a great deal, right? But hold on, there is a catch. They've put an upper limit on this deal. This means you might get less than that $106 worth of Millrose stock if things move a certain way. This upper limit is set to make sure that if Millrose's stock price does something crazy, they aren't giving away too much. It is a bit of a safety net for Lena, but it means for you, the shareholder, the deal might not be as sweet as it initially sounds. How do they figure out these prices? They look at the average stock price over 3 trading days right before the offer ends. This averaging period is crucial because it sets the final exchange ratio. So even if the stock price jumps around, the final deal is set by these 3 days. Let's peek at the numbers as of the 9th of October 2025 Lena Class. A common stock was trading at around $117.91 a share, and Millrose Class A was at $32.39 a share. This gives us a real-world hint of the exchange ratio. If you look at the table showing the market prices over the last year for Lena Class A common stock and Millrose Class A common stock, you'll see quite a bit of fluctuation. This volatility is important because it directly impacts how many Millrose shares you'll get for your Lena shares. Alright, let's get into the financials for Millrose. This section is where we see the real story unfold. We're going to look at numbers from the past and what they might look like after all these big changes. For the 9 months ended the 30th of September 2025, Millrose reported option fee revenues of a whopping $391 million. Compare that to zero for the same period last year before the spin-off, and you see the immediate impact of Millrose operating as its own entity. Looking at the combined financial statements for the period before the spin-off for the entire year 2024 and 2023, Millrose actually reported losses. For 2024, it was a loss of $246 million, and the year before that, $209 million. This is because those costs were essentially absorbed by Lena before the separation. But fast forward to the 9 months ended the 30th of September 2025, after the spin-off they reported a net income of $257 million. That is a massive swing and shows the potential profitability once divorced from Lena's overhead. On the balance sheet as of the 30th of September 2025, Millrose reported total assets of over $9 billion. This is a huge jump from a mere $5.4 billion as of the 31st of December 2024. This growth is largely thanks to all the land assets that came over in the spin-off and subsequent acquisitions. Liabilities are also significant at over $3 billion, showing they are using debt to finance their operations. In terms of cash flow for the 9 months ended the 30th of September 2025, operating activities generated a healthy $253 million in cash. That is a positive sign, but look at investing activities for the same period that shows a staggering outflow of over $2.1 billion. This is them putting their money to work buying up land and making investments. Financing activities, however, brought in over $2 billion, which helped cover those outflows and manage their cash. Now let's look at a key metric for REITs adjusted funds from operations, or AFO. For the third quarter of 2025, Millrose reported AFO of about $122 million. This translates to 74 cents per S-share on a diluted basis. This is a measure that tries to show the true cash generating ability of the company by adjusting for certain non-cash items and one-off costs. It is a really important number investors look at to gauge the REIT's performance. Now, no corporate deep dive is complete without talking about risks. And oh boy, Millrose has a truckload. They are a newly formed company with limited operating history, which is always a red flag. Their business model relies heavily on customers actually buying the land they develop. So if the market cools down or builders back out, they could be in serious trouble. And get this, some of their dealings are with Lennar, the very company they spun off from. This creates what they call conflicts of interest. Basically, Lennar has certain special rights that Millrose cannot offer to anyone else. This could spook new customers and investors who might worry about favoritism. There is even a clause where Lennar could stop all payments if there is a dispute. That could seriously cripple Millrose's cash flow. They've also not gotten independent appraisals for their land, which might mean prices are a bit fuzzy. Then there is the structure. Millrose has two classes of stock, Class A and Class BC. Class B stock has way more votes per share. This means a small group of shareholders, mainly the Miller family who own most of the Class B stock, can basically control the company. This dual class structure can make investors wary and potentially drive down the stock price for Class A shares. And let's not forget the re-qualification. They want to be a real estate investment trust which offers tax benefits, but it comes with super strict rules. If they mess up even slightly, they could face hefty corporate taxes, which would be a disaster. They are relying on their manager Carlyle to keep them on the straight and narrow, but Carlyle is new to managing public companies too. Looking at the agreements between Millrose and Lennar, the founders' rights agreement stands out. This gives Lennar a lot of power, like approving Millrose as manager and even influencing capital allocation. This is a big deal because it means Lennar still has significant sway over Millrose's direction, even after the spin-off. Additionally, the Hopper license agreement, where Millrose licenses the Hopper technology from Lennar, is critical. If this license were to be revoked or changed, it could seriously disrupt Millrose's business, and the fact that Lennar provided the initial land assets is a major concentration risk. Millrose's success is tied at the hip to Lennar's performance and decisions. The management agreement with KL outlines that KL gets paid a hefty 1.25% of tangible assets as a management fee. This is a pretty substantial fee and takes a bite out of potential profits for shareholders. While KL has experience in land banking, they are not experienced in managing a public company, and their compensation is not directly tied to Millrose's performance, which raises questions about alignment of interests. So what is the verdict? Millrose is doing some impressive things with its land banking model, especially in generating revenue post-spin. The growth in assets and the strategic moves into new markets are notable. However, the reliance on Lennar for a massive chunk of their business, the influence of the Miller family through Class B shares, and the overall complexity of managing a REIT that is also externally managed by a firm new to public company oversight all present significant risks. The exchange offer itself adds another layer of complexity with its pricing mechanisms and the potential for reduced gains if the upper limit is hit. For investors, this situation demands caution. Millrose's future hinges on navigating these complex relationships and risks successfully. The potential for high returns is there, but it is balanced by substantial potential downsides stemming from its structure, its reliance on Lennar, and the inherent risks of the land development market. Alright, that is our deep dive into Millrose's latest filings. What are your thoughts on Millrose's strategy and the risks involved? Let us know in the comments below. If you found this breakdown helpful, give this video a like and make sure you are subscribed for more corporate financial insights. And don't forget to join our Discord community to keep the discussion going. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.